The yield is real. The return isn't. I was sitting with a spreadsheet last spring. A friend had moved $80,000 into a Treasury bill ETF, 5% yield, FDIC, adjacent safety. The kind of decision that feels responsible, the kind that gets nodded at in conversations about being financially mature. And on paper, the numbers looked fine. Then I started tracing where the money actually went. Not the yield, not the principal, the purchasing power. That invisible thing nobody tracks on a brokerage statement. And what I found wasn't dramatic, it wasn't a scandal, it was quieter than that, which is exactly what made it unsettling. The money was shrinking, slowly, predictably, and the mechanism doing it was one most investors had been specifically told to trust. Here's what I want to walk through, not to alarm, not to advise, but because the actual math of safe yield in 2024 and 2025 is different from what most people running it in their heads have calculated. And the gap between what people think they're earning and what they're keeping has a name most financial media doesn't use: tax drag. And it compounds, not the way interest compounds, the way a slow leak compounds. You don't notice it until you lift the hood. Let's start with what people actually believe they're getting. A money market fund yielding 5%, a T-bill ETF with a 4.8% distribution. These numbers are real. They're not marketing fiction. If you hold $100,000 in a fund like that for a year, the fund will credit you roughly $5,000 in distributions. That part is accurate. That part is not the problem. The problem is what comes next. Those distributions, in most money market funds and T-bill ETFs, are classified as ordinary income, not qualified dividends, not long-term capital gains. Ordinary income, the same tax category as your paycheck. And that distinction matters more than almost anything else in this conversation. If your household income sits somewhere between $89,000 and $190,000, your federal marginal rate on that $5,000 is 22%. That's $1,200 gone before you touch it, gone before inflation is even mentioned. So your $5,000 yield just became $3,900. But we're not done. Most states tax ordinary income. The average state income tax rate for someone in the middle of that income range hovers around 5%. Some states, California, New York, Oregon, go higher. Add another $250 on that $5,000. Your $3,600 just became $3,650. Effective yield after taxes? About 3.65%. On an instrument your brokerage dashboard still shows as yielding 5. If this math landed differently than you expected. It helps the pattern reach others running the same numbers. Now we introduce inflation. And this is where the mechanism gets strange. The Consumer Price Index, CPI, is the number most people use when they think about inflation. It ran around 3.4% in 2024, some months higher. So intuitively, a 3.65% after-tax yield against 3.4% inflation sounds like a hair's breadth win, barely positive, a rounding error in the right direction. Except CPI doesn't measure your inflation. This is the part that took me a while to sit with. CPI is a basket. It's averaged across millions of households. It weights housing, food, energy, healthcare, education, but it weights them the way a statistician weights them across all consumers. And if you're a college-educated professional between 40 and 60, your actual spending pattern looks nothing like that basket. Healthcare costs for people in that demographic have risen faster than CPI for most of the last decade. Housing, if you're in a metropolitan area, has risen faster. Education, if you have children in college, has risen much faster. The actual price increases hitting your specific life have, for most people in this income range, outpaced CPI by 1 to 3 percentage points in any given year. Economists call this personal inflation rate. It doesn't get a ticker symbol. It doesn't get reported on quarterly, but it's the number that actually determines whether your purchasing power is growing or shrinking. Run the math with a conservative personal inflation estimate, say 4.5%, not dramatically above CPI, just reflecting the actual composition of spending for a typical household in this income range. After-tax yield, 3.65%. Personal inflation, 4.5%. Real return, negative 0.85%. Your safe investment is losing purchasing power at a rate slow enough to feel like safety, at a rate fast enough to matter over time. For minds that sit with that number rather than move past it, subscribe. The next pattern is already forming. That's the trap, not a scam, not negligence, a structural feature of how these instruments interact with the tax code and with the gap between official inflation and lived inflation. But it gets more specific than that, because not all safe yield instruments carry the same tax profile, and the differences are almost never explained in the headline yield number. Treasury bills and Treasury-only ETFs have one distinct advantage. Their income is exempt from state and local taxes. That's meaningful. For someone in California, at a 9.3% state rate, that exemption changes the math significantly. Your federal tax still applies, but stripping out the state layer can recover 40 to 80 basis points of your after-tax yield, depending on your situation. Money market funds, the kind holding a blend of commercial paper, repurchase agreements, and short-term corporate debt, carry no such exemption. All income is fully taxable at every level. Same headline yield as a Treasury fund, very different after-tax yield. The brokerage dashboard shows you the same number. The tax bill does not cooperate. This is the hidden asymmetry most people holding money market funds never encounter in the marketing literature. Here's another layer. The yield environment we've been living in since 2022 is itself a product of a specific Federal Reserve posture. When the Fed began raising rates aggressively, money market funds and T-bill ETFs became genuinely attractive. For the first time in 15 years, hundreds of billions of dollars flowed in. By late 2024, money market fund assets collectively crossed $6 trillion. $6 trillion parked in instruments most investors believed were working hard for them. And from one angle, they were. From another angle, that $6 trillion is collectively earning a real after-tax return that for many of those holders is negative or barely positive. The system worked exactly as designed. The tax code applies. Inflation applies. The yield number on the dashboard does not adjust for either. Those who run the full calculation play these instruments very differently from those who stop at the headline number. Few do. The irony is structural. The higher the interest rate environment, the more attractive these instruments look. And the higher the interest rate environment, the more aggressively the Fed is typically fighting inflation, meaning the inflation these instruments are supposed to help you outrun is precisely the condition making them look attractive. They glow brightest when you need them most. And when they glow brightest, the inflation eroding them is also running hottest. I want to pause here, because the instinct at this point is to ask, compared to what? And that's the right question. Cash sitting in a savings account, still as of early 2025, yielding under 1% at most major banks, despite the rate environment, is not the alternative. The alternative space is broader and more nuanced than a binary between money markets and equities. But the comparison I find most instructive is I-bonds. Series I savings bonds issued by the U.S. Treasury have a structure that directly addresses the personal inflation problem. Their yield is indexed to CPI. When inflation runs hot, the yield adjusts upward. They're also exempt from state and local taxes. There's a purchase cap, $10,000 per person per year, which limits their utility as a full solution. But as a structure, they do exactly what a cash equivalent instrument should do. They preserve purchasing power by design, not by assumption. The contrast with money market funds is quiet but sharp. One instrument is designed to track the thing eroding your money. The other is designed to yield a fixed rate and let you figure out the rest. Some truths about how yield is packaged sit uncomfortably once you've seen the architecture beneath. The discomfort is the point. Now let me walk through what this actually looks like over time, because single-year math can feel abstract. Compounding makes it concrete. Assume a $200,000 position. the kind of balance that isn't unusual for someone in their late 40s or early 50s who has been disciplined about saving. Money market fund, 5% yield. Tax situation as described, 22% federal, 5% state. Personal inflation at 4.5%. Year 1, nominal gain $10,000. After tax gain, $7,300. After personal inflation, real gain, negative $1,700. You ended the year with nominally more money and economically less purchasing power. Year 2, same conditions. The compounding now works against you slightly because the base is larger in nominal terms but smaller in real terms. The gap widens. Over 5 years, a position that your brokerage statement will report as having grown by roughly $55,000 in distributions will have, in real purchasing power terms, shrunk. Not dramatically, not catastrophically, but definitively. The ledger and the reality point in opposite directions. This is what tax drag looks like when you let it run. And here is the thing about tax drag that distinguishes it from other investment risks. Market risk is visible. Volatility shows up on a chart. A 20% drawdown announces itself. People feel it and respond. Tax drag announces nothing. It shows up nowhere on your statement. The yield number is accurate. The distribution is real. The tax bill arrives in April, and by then, the mental accounting has already categorized the year as a good one. The 5% yield registered as income. The purchasing power erosion registered as nothing, because it never appears. This is the stealth in stealth taxes. Not that the taxes are hidden. They're filed openly, reported accurately, paid on time, but their interaction with inflation, and specifically with the gap between reported inflation and personal inflation, creates a loss that has no line item, no timestamp, and no drama. It doesn't feel like losing. That's the mechanism. What we don't understand about these instruments continues to work against us, quietly, on schedule. I want to address the counterargument that's probably forming. The counterargument is this. Even at a slightly negative real return, cash-equivalent instruments serve a purpose: liquidity, stability, psychological anchor. Money market funds are not meant to build wealth. They're meant to preserve it, and in that function, they perform adequately. There's truth in that. Liquidity has value. The ability to access funds without market timing risk is not nothing. It's meaningful, especially for near-term expenditures or as a buffer against uncertainty. I'm not dismissing that function. What I'm examining is whether investors who believe they're earning in these instruments are actually experiencing a loss, and whether they know it. For money held as genuine short-term liquidity, the math I've described is an acceptable cost. For money held because 5% feels like growth, because it feels categorically different from the 0.1% savings account of 2020, the math changes the story. The difference between liquidity management and yield chasing is, in this environment, the difference between understanding what you're doing and being lulled by a number that doesn't include its own cost. Here is where the chain reaction extends outward. If 5 to 10% of a household's net worth is in cash-equivalent instruments for legitimate liquidity purposes, the tax drag is a carrying cost, unpleasant but bounded. If 30 to 40% of a household's investable assets shifted into these instruments during the 2022-2023 rate cycle, as surveys suggested was common for risk-averse investors in that income bracket, then the drag is not a carrying cost. It's a structural drag on wealth formation that runs silently for years. And when rates eventually fall, as they began to in late 2024, the yield attractiveness evaporates faster than the habit of holding. People move into these instruments during high-rate environments because the yield number convinces them. They stay in them during falling-rate environments because inertia is powerful and because leaving requires making a decision. The yield drops to 4%. Then 3.5%. The tax drag and personal inflation calculation shifts, but the threshold for negative real returns shifts too. At 3.5% yield with a similar tax situation, after-tax yield is closer to 2.5%. Personal inflation at even 3% puts you negative. The trap doesn't disappear when rates fall, it deepens. This is the second-order consequence. The rate environment that made these instruments attractive will not last. The structural features of these instruments, the tax treatment, the fixed nominal yield, and the invisibility of purchasing power erosion persist regardless of where rates go. The money that moved into $6 trillion of money market assets in 2023 and 2024 did so because the yield was exceptional. That exceptionalism is temporary. The mechanism is permanent. One more layer I want to surface. The financial services industry benefits quietly from this dynamic. Money market funds charge expense ratios, small ones, often 0.5 to 5% annually on $6 trillion of assets. That's a significant revenue line for fund companies. The marketing around these products emphasizes yield, safety, and liquidity. It does not emphasize after-tax real return. It does not use the phrase personal inflation rate. It does not calculate what you're keeping. This isn't conspiracy. It's incentive alignment. The industry earns on assets held. Yield numbers attract assets. The full tax and inflation-adjusted math of these instruments is less compelling than the headline number, so the headline number is what gets communicated. The investor who knows to run the full calculation is in the minority. The investor who trusts the dashboard yield number and feels appropriately conservative and responsible is the majority. And the majority in this structure is slowly losing purchasing power while the dashboard tells them they're winning. That asymmetry of information isn't illegal. It isn't unethical in a prosecutable sense. It's just the architecture of how yield is communicated versus how yield is experienced. A final frame. A century ago, money held in a bank earned interest. That interest was designed, at least nominally, to compensate the depositor for the time value of their money and the erosion of inflation. The system was simple enough that the headline rate and the real experience roughly matched. What we have now is a more sophisticated system. More products, more options, more yield surface area. And the sophistication has not served the depositor more precisely. It has created more ways for the gap between the number and the reality to widen quietly. Your savings statement will show growth. Your purchasing power will not always agree. The number on the screen is accurate. It's just not the number that matters. If this pattern holds your attention, the channel holds more like it. Subscribe quietly. Pass this to one person who has called their money market position a safe return. They've run the headline number. They haven't run all of it. The observations you're forming right now, bring them below. The comments are where the pattern continues.